FA1 Part C. Recording and Accounting for Credit Transactions. Chapter 13. The Receivables Ledger. The topics that this presentation will cover are 1. Personal accounts for credit customers. 2. Recording transactions in the receivables ledger. 3. The age analysis of receivables and other reports. 4. Irrecoverable debts. 5. Allowances for irrecoverable debts. 1. The receivables ledger contains all the personal accounts of all credit customers for a business. These accounts are kept in order to record how much each customer owes, and the items that make up their debt. These are some of the reasons that a business may need personal accounts for their customers. A customer will contact the business, wanting to know how much he owes. The staff of the business need to be able to answer him. Personal accounts are kept, so that statements can be sent to customers at the end of the month. On the statement, it needs to show how much is owed at the beginning and end of the period, any new invoices sent out, and any payments received from the customer. The managers of the business will want to keep a check on the credit position of individual customers, to ensure that no customer is exceeding their credit limit, and so that payments received can be matched against debts owed. In order to ensure that when a business supplies goods on credit, they will receive their payment, there are three main authorization procedures that are generally in place. 1. When allowing a customer to have a credit account, it needs to be authorized. Authorization will probably require references from other suppliers of the customer, and also references from the customer's bank. The customer's credit limit will also depend on the information that is supplied. 2. Before the goods are dispatched to the customer, the order may need to be authorized by the credit control department. If the customer has overdue invoices, it may be decided that no more orders can be accepted from the customer, until payment has been received. 3. Businesses should have procedures for the authorization of invoices, discount allowed and credit notes before these types of transactions are started. Most businesses buy and sell to each other on credit. By trading on credit, businesses have the benefit of being allowed to trade without having cash up front. Businesses who trade with credit would like to receive cash quickly from their customers, and delay paying their suppliers for as long as possible, although this could lead to problems. Businesses aim to control the problem with credit control. Customers will be given a credit limit. If an order from a customer exceeds their credit limit, the order will not be fulfilled until a payment has been received. A business can also use an aged receivable analysis to help with credit control. An aged receivable analysis shows how long invoices are outstanding, and will also show which invoices to chase up payment. Credit customers may fail to pay their accounts because of dishonesty, or because they have become bankrupt and cannot pay. Credit customers from another country may be unable to pay, due to a foreign exchange restriction imposed by their government. So therefore, the costs of offering credit are interest costs of an overdraft, if customers do not pay promptly. The costs of obtaining payment, for example, debt collectors. And court costs, for example, if the customer needs to be sued in order to collect payment. An account receivable is a person or business who owes the business money. The balance of their account is usually a debit, because a receivable is an asset to the business. The receivable ledger, sales ledger, contains all the individual customer accounts, showing the amount which they owe the business. When invoices are recorded in the sales day book, they are also recorded on the debit side of the receivables ledger. When payments and discounts allowed are recorded in the cash book from a customer, they are also recorded on the credit side of the receivables ledger. And when credit notes are recorded in the sales return day book, they are also recorded on the credit side of the receivable ledger. For an example of how a T account of a personal customer's account looks like, see page 268 of your interactive text study guide. The personal accounts of customers are kept as memorandum accounts, which means they do not form part of the double entry system. The transactions involved are already recorded in the sales return day book, and the cash book, and posted to the general ledger. If they were part of the double entry system, then the transactions would be recorded twice. In some computerized systems, the receivable ledger is integrated with the general ledger, so there is no separate total receivables, or receivables control account, and the various customer balances actually make up the total receivable account. The following businesses do not need a receivable ledger. Businesses who do not have credit sales, for example, chains of supermarkets, who make all their sales with cash, check, and debit and credit cards. Businesses who don't sell enough to other businesses for it to be worthwhile for them to operate a receivable ledger. 2. It's common for a business to have individual customer accounts. They are kept separate from the general ledger, in the receivable ledger, as memorandum accounts. The transactions kept in the receivable ledger do not form part of the double entry. Instead, there is a total receivables, or receivables ledger control account kept in the general ledger, to keep track of all the transactions kept in the receivable ledger. For an example on recording receivable ledger transactions, see the example on pages 269 to 270 of your interactive text study guide. For an example of how you would post those transactions to the general ledger, see the example on page 271 of your interactive text study guide. The source books or books of prime entry for the receivable ledger, memorandum accounts, are sales day book, sales return day book and the cash book. From the sales day book, sales including sales tax, VAT, are debited to the receivable ledger. From the sales return day book, sales returns including sales tax, VAT, are credited to the receivable ledger. And from the cash book, cash received is credited to the receivable ledger. The source book or book of prime entry for the general ledger, the double entry involving invoices, is the sales day book. From the sales day book, the total receivables, including sales tax, VAT, is debited, and the sales and sales tax, VAT, is credited to the general ledger. The source book or book of prime entry for the general ledger, the double entry involving cash received, is the cash book. From the cash book, the total receivables, including sales tax, VAT, is credited, and the cash account is debited to the general ledger. The source book or book of prime entry for the general ledger, the double entry involving credit notes issued for goods returned, is the sales return day book. From the sales return day book, the total receivables, including sales tax, VAT, is credited, and the returns account and the sales tax, VAT, account are debited to the general ledger. For a diagram of the receivable ledger posting process, see page 272 of your interactive text study guide. In order to check the accuracy of amounts that have been recorded in the receivable ledger memorandum accounts, work out the total of the balances on the individual receivable ledger accounts and compare it with the total balance of the general ledger receivable account. If they don't agree, then an error or errors may have been made. Discount allowed is kept as a memorandum column in the cash book, because it has nothing to do with the actual cash or monies being received. The double entry for discount allowed is debit, discount allowed. Credit, trade receivable and receivable control account. The cash received plus discount allowed equals the total debt that needs to be cleared. Stop the lecture. Answer the question on page 273 of your interactive text study guide. This is the end of part 1 of chapter 13. See the next video for part 2 of chapter 13.